Welcome back, traders. Got a very special ICT lecture today. He is teaching his Venom model. We've had examples, or maybe just one example of this before, and I remember him saying that he would never teach this, but here we are. Now, I don't expect him to teach everything about it. He may hide a few things, but hopefully this intro will give us enough information so if we do decide to dig deeper, we can figure out all the nuances. But let's get right into it. Please like and subscribe, and as always, the original video will be in the description.
Folks, welcome back. So we're looking at the April 3rd, 2025 review on NASDAQ futures. And I'll be teaching you my Venom model. All right, so we're looking at the 1-minute chart on June delivery, NASDAQ futures. And this is the opening range. And you can see it's obviously over 1,000 points difference between previous regular trading hour settlement price and that of the opening price this morning at 9:30 Eastern time. So when I taught how to use the opening range gap, how to trade with inside opening range itself, which is the first 30 minutes, 9:30 to 10 o'clock Eastern time. If there's an extreme gap lower, it's likely to not even trade back to consequent encroachment, which is generally a 70% likelihood occurring in the first 30 minutes of trading. But when we have 1,000 or 1,100 almost points or handles on NASDAQ opening lower, given the climate also with the tariffs and whatnot, it basically makes it next to impossible. It makes it pretty much likely that it will not make any attempt to rally higher. It doesn't mean that it won't trade back inside the opening range gap, but it will do it modestly. As you can see, it does here. Okay, and I'm going to ferret out a little bit more detail here. The highs in here on NASDAQ were not agreed with in ES. All right, we're going to take our attention over to the new day opening gap, which is where we opened up at 6 p.m. Eastern time yesterday evening, and where we settled at in electronic trading hours. You can see that down here. Okay, and I put the quadrants in, so upper quadrant, lower quadrant, and consequent encroachment level. Now, given the underlying weakness of NQ because of the tariffs and whatnot, it would be reasonable to anticipate that this new day opening gap is pretty much the extreme of retracement into the opening range gap itself. So if we look at these levels over here, we're going to go back over showing the pre-market hours, 8 o'clock, 9:30. You can see how we traded up into the lower quadrant here. And then we had this rally a little bit slightly higher than that. The opening price at 9:30 is this candlestick right here, right at that price right there. And I extend that through for your benefits. You can see how it behaves and respects or dismisses the level that's been used for the first opening tick at 9:30 Eastern time today in regular trading hours. So everything prior to 9:30 in this chart, all of this is electronic trading hours. The question is this in the morning: what are we doing after the opening bell at 9:30 Eastern time? What is the market going to use for draws on liquidity? For what purpose? And then once it goes there, what will it do next? This is Venom's model narrative. Without going into great detail, everybody knows that I'm looking for 17,750 on NASDAQ. At 9:30, what I like to do is I like to look back and see at the start of 8 o'clock's hour. I want to see where the high is and where the low is inside that previous range. What am I saying by previous range? Denote 8 o'clock in the morning. From 8 o'clock until 9:30, that's a 90-minute window. I want to know where's the high and where's the low inside that range of time. Okay, very, very specific things here. Since we're under the impression that the market is likely to go lower because of the impact and weight of the tariffs that Trump's been implementing, the bias should already be naturally oriented to being bearish. But how can we use that information? Well, you're going to look at it from the lens of having this high inside 8 o'clock to 9:30. That's your buy side. See how easy that is? It's not ambiguous, is it? It's very, very, very specific. And then we have the low formed inside that 90-minute window.
Okay, so a lot of preamble here. I'm 10 minutes in, and the only thing on the Venom model so far is the buy side liquidity and the sell side liquidity from 8 o'clock to 9:30. So far, it sounds like the 2022 model. I see a sweep of buy side here. I see a bearish breaker with a fair value gap. And here will be your short entry aiming for the pre-market lows.
It just means that these are your first initial frames of reference for looking for the opening range or the trade going into 10 o'clock to 10:30. Okay, so that first hour of trading, that's kind of like really the whole basis of what I've been doing for 2025, using what I've already taught, but focusing on that small little 60-minute window of opportunity. So because we're likely to see lower prices, it makes sense for the market to do what? To make its market protraction to the high first. What high? That high right there. So this high is going to have much more significance than that of the low here, meaning that at 9:30, the market's going to gravitate to that high here first. Why? Because anyone that's short, the algorithm is going to unseat them and allow smart money to accumulate their positions after being stopped out. What kind of stop is it going to be? When price trades above this high, it's going to be buy stops, which is extremely convenient for smart money to want to be counterparty to, selling to those buy stops and then anchoring and fortifying their short positions here. Notice this high here and this high here, they're relative equal highs. This punch higher right there, this is where you have to be paying attention to, okay? This candlestick right there, that one right there, that is the venom. This high, you have relative equal highs. They're known, they're predetermined. Then market drives up into it. It leads. This is the signature, folks. Okay, this is what makes venom. When this candlestick shoots above both these highs here, that's the raid on the buy side liquidity. The candle is left inside of that pool of liquidity above these highs. But here is what confirms its venom. There has to be an inefficient run higher to it and then an inefficient run away from it. See that? That makes this area right in here fangs. Think of it like a viper or a mamba. Okay. This is a snake coming up and biting and venomizing those individuals that were short, that have buy stops there. That little movement there in that candlestick laying and closing, it has to close above these relative equal highs. Once it does that, it's confirmed that it's likely setting up venom. When it breaks down on the next candle here and it closes here, you have an imbalance here, that means it introduced and venomated the buy side. It poisoned them and then quickly left. So these are the two fangs. They're your telltale signs. The way you can trade it is you treat that as a real turtle soup, not some goober on X pretending he authored something. This is one of the highest forms of reversal patterns.
Okay, first, I just have to say it's hilarious how he uses all these terms to basically describe a stop hunt. Venomated, I don't even think that's a real word. And then these fangs, it's basically a balanced price range. Price does go back to it, but it should not close above 50%. And we've seen stop hunts and balanced price ranges 100 times before, so I'm trying to understand what makes this Venom model so special. What are the warning signs that will let us know when we're going to have a Venom model, or what confirms it? I guess these fangs do confirm it. But as we continue, I want you to think about where would you have your risk if you took this Venom trade? A lot of questions to be answered.
This candlestick's closing price is the change in the state of delivery. When price trades up to it here, that's your low risk entry. High risk entry, where you have to have a great deal of conviction, is when it trades above it, you're entering as it runs up into it. And so this is Venom. We have the up close candle that's inefficient, and then sell side offered in a singular candle where it's just run up, drop the poison in, and then leave it. Then you have change in state of delivery. So the highest form of this would be sell short above the relative equal highs, because the narrative, it's going up first to take that buy side out and then gravitate towards what level? The level I gave also this morning, 18,830 sell side. Electronic trading hours low, electronic trading hours high, inside that 90-minute window of 8 o'clock to 9:30. those are very, very specific highs and lows, folks. And if you know where the likely draw is on the weekly chart, it means if you're expecting the market to be predominantly bullish or bearish for the week, then only focus on the buy side in that realm. If you're bullish, you're looking for the sell side in that 90-minute window at 9:30. It's simple. It's simple. So you're going to miss some trades. Let me say that also. Sometimes it won't go to your high or low, and it starts running. And what are you doing that? Well, you use the opening range gap, or you use consequent encroachment, or you use the silver bullet. There's so many things. I'm not showing anything tonight with my live accounts because I'm reserving what I'm doing in those to my own personal business. But I used a demo account today. So that way, here's where we're going to be very upfront and transparent. Okay. What I'm going to share with you tonight was done in a demo account. Two reasons. Number one, I don't want to mess up anything in my personal accounts, and I want to hold on to what I preach. I said that it was going to be likely to be a difficult session, but when this setup formed, I went with it. And because I wasn't going to try to teach Venom, I used a deferred entry model, and I'll show you that also. But Venom is this: run to the buy side in a bearish market inside the 90-minute window of forming your buy side and sell side envelopes, where above that is buy side, below that is sell side. And then when we rally up, we leave the candlestick on a closing basis above the buy side, which needs to happen first when you're bearish. Then it needs to have a candlestick that's inefficient higher as it delivers it, leaves the candle up in there, and then quickly leaves it and runs away. And because this candlestick and this candlestick acts like a fang, they're two fangs. It goes up, introduces the venom, the poison, knocks out those that are short, they can't participate, and then it quickly runs away. That's your signature. Then you wait. You either take institutional order entry drill above this candlestick's high as your entry, or if it can afford you an entry back to the opening price of the last candle, which is the venom order block, that is your change in the state of delivery. You can see it delivers it there, goes up 2 more ticks just to make sure the price is there, and then it runs away. Then the market breaks down, and you have another little fair value gap here with first percent of fair value gap. So in here, I'm waiting for it to trade up into first percent of fair value gap, and then inside of this gap that I will not have highlighted in this presentation, but I'm looking at it when I'm watching price. So you see my entry will be on this candlestick here inside of this gap. I was masquerading as someone that was just simply looking for the first percent of fair value gap, and I wasn't trying to draw any attention to Venom.
Okay, so he repeats the Venom model. It still just sounds like a stop hunt or a turtle soup to me. You do have 2 entry points. You have the low risk entry here, or better named the higher probability entry, because it's more likely to work in your favor since you have the market structure here to the left. And I will have my risk above the high or just above the bodies. Now the high risk entry here is the Venom itself. Here, I wouldn't know where to put my initial risk, maybe an arbitrary 20 points above the high. But if I'm lucky enough to see this reversal candle, I will quickly move my stop to just above the bodies. I will also want to take a partial into this fair value gap and potentially adding it back in at this low risk entry. Even if price starts to run away without you, as long as we don't take the sell side here, you can still enter here or here on this fair value gap. Since this is above the 9:30 opening, you can still consider this as a premium fair value gap. But here and here, these are the 2 main entries. And keep in mind the time and higher time frame bias. He's really emphasizing here on the 8 to 9:30 liquidity and the weekly bias or weekly direction.
So once that buy side's hit, the market starts to move lower and gravitate towards that low here. What makes that low so special? Remember, it's the lowest low in the 90-minute look back at 9:30. But the market needs to be predisposed to go one direction. If you're trying to use this model when it's in a middle of a trading range and it's had several large range candles up or down, Venom will not appear in that. It's not going to appear in that. The nature or the underlying premise behind this model is it's going to unseat those individuals that would otherwise be profitable. You have to have that in the context of why you would even be looking for the setup. Otherwise, it won't be there. And you're going to see people out there trying to look for these setups, and they're not going to be in there because they don't understand the underlying context of the marketplace. We'll continue and move on into more details. Now, here is the executions I used. This is going to be because I was going to show you this as the trade example for today and not mention or draw any attention to my Venom model. But Venom was the underlying premise as to the levels I gave. Okay, so you can see it's not market replay, but in fact, this is an execution done on demo because number one, I want to remind you that it's okay to do this in higher risk environments. In fact, I'm actually surprised to see my model deliver as well as it did today. I mean, this is learning experience for me. You know, seeing my tools and things being pressed in these high stress conditions where the market is extremely manipulated and has a great deal of volatility, and to see it delivering still like this is just, it's fabulous. I love it. So you can see that the entry right here, 18,991. That's inside of that gap right there. And I like the fact that it traded up there and fell short of the new day opening gap low. That's the signature I teach. If it can't touch that, is it weak? Yes. When the market should move lower. And that's why I felt confident when it was trading back down inside that. That's when I entered. I'm just giving you more examples of how you can formulate a model. Now, if you strip away the essential core elements to what Venom is, I've taught it already. But how it's put together in a model where it repeats with a underlying premise. Why should it do this? Versus, I'm going to look at a down closed candle and call it an order block, and when it touches it, I'm going to buy it. So anyway, I use this fair value gap here with the pretense of everything I outlined with the Venom model. The market breaks lower from there, zero drawdown on the entry, and then we have this inefficiency in here, and the market trades up into that. Notice this big candle right here. See that? All the way up to the volume imbalance. See that little separation between the bodies? That open of that candle's higher than that close. So that means you have to incorporate that as well. So this is buy side imbalance, sell side inefficiency. And if we're bearish and we trade down below it, what does that make it? An inversion fair value gap. And because of that, and we were trading above the opening price. See that? Above the opening price. Power 3. Okay. Not some garbage candle range theory. Okay. Timu version. This is how you're entering with smart money algorithmically. The fact that we traded up above that opening price and inside this inefficiency. Well, let's do this. You can see the gap, inversion fair value gap, and then my entry here. And then it breaks down aggressively. And I highlighted this one. It's a gap as well, but I already had a rectangle over top of what I was showcasing. And it breaks lower, trades back up into, fails to get the consequent encouragement of this inversion fair value gap, which is weakness. And we trade down below the electronic trading hours, which is pre-market hours, sell side liquidity. And there's the limit order getting filled there. And then me doing the manual exit where I did not let my limit order, which was below where I got out at. And it actually went about, I don't know, 10, almost 10 handles, 15 handles more than where my limit order was. And then it turned around and came back up, traded back up into the inversion fair value gap, this larger one. Notice the volume imbalances in here. We're going to scrub over a little bit. And you can see now that's the electronic trading hours. It trades up into there. And that shaded box is this inefficiency, sell side imbalance, buy side inefficiency. It tags the consequent encouragement of that as well.
So seeing the bigger picture now, I would definitely have my stop loss above this fair value gap if I were to take the Venom entry. But honestly, I think it would be hard for new traders to enter here. This low risk entry would be easier to shoot for in my opinion. But anyways, this was during non-farm payroll Thursday, so that's why ICT not only paper traded, but notice his sizing. It's much smaller than his normal size of 8 to 10 contracts. So this shows how even ICT is wary of non-farm payroll week. And if you are trading during NFP, size down, at least half your normal size.
All right, looking at the morning session again with that sell side bounce buy side efficiency, you can see it trades up in the consequent encouragement. All that right there is just beautiful, beautiful detail supporting the idea that's going to move lower. All right, let's move ahead a little bit in the day. At 11:30, I teach that begins the New York lunch period, which is a 2-hour period. So 11:30 Eastern time to 1:30 p.m. Eastern time. That's what's shaded down here. That's when you anticipate the lunch macro. Okay, and what you're doing is, and I've taught this before, you want to look at 10 o'clock. Here's 10 o'clock. And at 10 o'clock, start walking forward. Where's the high at that forms when you're bearish? And it's going to come back and knock out those stops. There it is right there. So at 11:30 here, the market's going to start gravitating towards that high. Or it does, in fact, move higher. It uses the inversion fair value gap now becoming reclaimed order block, rallies up, trades up into those volume imbalances, and clears the buy side here. So anyone that's short on the day is not going to be allowed to take a ride below that low that formed in the morning session. The market breaks lower, trades to the CIVI here, breaks down, fails to get into that CIVI there. That's weakness. And we start using that fair value gap levels with those lines there. Okay, and in the afternoon we have here at 1:30, I teach that begins the opening range for the PM session. So 1:30 in the afternoon to 2 o'clock, that is your opening range for PM session. What do you do with that information? Well, I taught that the first presents a fair value gap, which is this one right here. If you're bearish, it's going to act as what? Inversion fair value gap. The market trades up into the old low here. That's what we were aiming for, that electronic trading hours low. It trades off of that up into a sell side balance, buy side efficiency, or inversion fair value gap rather. And it trades up into that fair value gap there. Look at the body stopping right there. And then breaks below that gap. So if I add that there, you can see the volume imbalance, you have to include that. We trade down below it. And then we wait for time. Where's the macro? 250 to 310. Trades up into it. Look at the bodies you're expecting it. And the market breaks away. First gap that forms after that, there's your entry. Look at the bodies you're expecting it. Sell off. And it takes out that morning session low there for your PM session trade. Beautiful delivery. Beautiful, beautiful delivery. And you can get a measurement on the bodies, the high and the low. The lowest close are open, the highest close are open in that range. That's what I'm measuring. And you get that price down here, 18,664 and a half. So that's it for today. It's a brief introduction to a very sophisticated, very precise, detail-oriented model using things I've already taught. A model is just simply taking components that I've already taught and put them in a context that makes sense, why price should do certain things. So we're going to take a look at the NASDAQ on a daily chart and closing. You can see that we have this big wick here. Note that I have this set to off. It would be blue if it was on. So I'm showing this candlestick right there, and the consequent encroachment of that candle is 17,749, which you understand now why I'm looking for 17,750. Why? Can it take out that low right here? It can, but what if it doesn't? What if it has a deep retracement before it takes out that low? That's why I'm using this consequent encroachment level. All it has to do is bump that low and not take out that low. And my target for the year, or the first half of the year, would have been met. But taking out this low here is first partial. And that's what I'm looking at next.
So this was a pretty good lecture. No new concepts. I don't really think he'll put out any new concepts, but he put together some of the things he's already taught and showed us his new Venom model. Not new to him, but new to us. And you can see it's fairly simple with multiple ways to enter, but ultimately the most important things remain the same. Where is liquidity? What is the higher time frame bias? And I think if you focus on the most important concepts and develop your skills to identify liquidity and the higher time frame bias, then you can make practically any model work in your favor. I put out my market outlook every week to give you guys ideas on the higher time frame. I'm also looking for price to go for these lows, but I do see a volume imbalance that lines up with an old low, so that may get retraded to first. Let's see what Friday does, and I'll give you my market outlook over the weekend. I do plan to live stream Sunday morning 9:30, so I may do it then, or I may just hang out and do some back testing. I'm gonna play it by ear this time, but I hope to see you then. Please give this video a like and subscribe, and until I see you next time, safe trading.